Hi, I'm Patu from freefincal, and let's take a look at a comparison between Mirae as a tax saver fund and Axis long-term equity. Before we begin, thank you for the response and email sent to SEBI uh, uh, based on what I had discussed last night on SEBI's consultation paper on changing the regulations for investment advisors. I had written a detailed post on this today. I had highlighted one more aspect of this consultation paper where they're trying to make investment advisors also distributors of products, which is just stupid and shambolic. I'll talk about this in more detail tomorrow because we'll have one more post on this probably tomorrow. We'll see tomorrow or a day after. Make one more video on this. But I would kindly request you to please go to this uh, article. Is SEBI trying to harm investor interest and destroy fee only advisory? I have attached a template for you to just copy and you can send the email to SEBI. Please do it so that you can save small, young fee only advisors, investment advisors. They would be completely killed off by just a few people if this comes into become a rule and so on. I don't know why SEBI is being misled like this. I don't even know if SEBI understands the ground reality of what's happening. But that whatever it is, we have to do what we can at this moment. And thank you for your support. Many others have already written based on this post, and I urge you who are watching this on YouTube as well to do that. So let's get to this. And these are two tax saver funds that have done quite well in the recent past. The Mirae fund was started in December 2015. As of today, it's got an AUM of a little more than 3,000 crores. Very low expense ratio of 0.28%, which means that they want the direct investors to invest in it. They can jack it up later, but for now it's 0.28%. Axis was launched in the Axis Long Term Equity Fund was launched in December 2009. It has got a very big AUM of 21 473 crores, probably because of the Axis Bank connection, but it's got a much higher expense ratio for the direct plan of 0.92%. Now, if you look at the since inception, that is since December 2015 when the Mirae Fund was launched, you can see that the Mirae Fund has done very well compared to the Axis Fund. And since December 2015, you can see the Axis Fund underperformed the BSE 200 up to about August 2018 or maybe even June 2019. And after that, it's kind of picked up a little bit. You can see why that is the case. But we'll have to dig closer than this. If you most ELSS funds are kind of they are large cap kind of oriented funds. This is also not an exception. This is Mirae Asset Fund. You can see it's got about 60 to 65% of large caps at all times. It's got about 20 to 15% of mid caps at all times. And compared to that, the Axis Long Term Equity Fund has had historically little higher exposure to mid caps, and that's probably the reason of the underperformance since January 2018 or so, when the mid cap started falling after budget day. So it's 2 years since then, and you can see that they kind of increased the large cap component a little bit in the last few months, and that's probably why the performance has increased a little bit. Of course, they are also still heavy on mid caps, a little bit more mid cap heavy than the Mirae fund. Now let's talk about excess risk and excess return of these funds for the last 1, 2, 3, 4, and 5 years. So excess return means how much more return the fund has got compared to Nifty 100. So if the excess return is positive, for example, in the last 1 year, Axis Long-Term Equity has got an excess return of 7.2% more return than the Nifty 100. Mirae about 5% more than Nifty 100. And excess risk means how much more volatile the fund was compared to Nifty 100. So you can see that for the last 1 year, Axis Long-Term Equity was a little more risky, volatile, but it compensated by giving you more returns. Mirae was less volatile than the Nifty 100, and it still was managed able to beat Nifty 100 at 5%. So ideally, excess return should be positive, excess risk should be negative, or excess risk can be small positive and excess return should be definitely positive. And over last 2 years also, you can see excess return for both is positive. Mirae has got less risk. Axis got slightly more risk. Over 3 years, again, both are positive, and both of them are slightly, excess risk is also slightly positive, excess return is also positive. So over the last 1, 2, 3, and 4 years, they have done quite well. They've been able to beat the index at more or less comparable risk or a little extra risk, which is fine. But if you beat the index and additional little extra risk, in hindsight, is not a problem at all. So in terms of getting risk-adjusted returns, both the Mirae fund and the Axis fund have done excellently well. And the next is downside protection consistency. How often the Axis fund and the Mirae fund fell when the index fell, and if it fell less than the index or more than the index. So you can see that the downside protection consistency for the Mirae fund is 82% for the last 1 year, which is more than the 63% for the Axis fund. You can see Axis fund is a little more volatile. The Mirae has done quite well. It has captured less of the index falls than the Axis fund. Over the last 2, 3, and 4 years, the Mirae has got 100% downside protection, which means whenever the index fell, the fund always fell less than the index. Whereas the Axis fund has got a consistency of 70%, 72, 73, and 84%, which is good. 5 years is 100% for Axis. No history available for 5 years for the Mirae fund. So again, in terms of falling lesser than the index, both these funds have done quite well. There's really nothing to choose between these two funds. They have very good downside protection. Their volatilities are probably the Axis fund a little more because of the additional mid caps. It brings a little bit more additional volatility, but then it has performed. It doesn't matter for now. So between these two funds, there's nothing to choose for new investors. Of course, new investors may worry about the large AUM of the Axis fund and choose the Mirae fund, which has got a lower expense ratio. For now, that definitely makes sense, but please remember they may hike it up at some point in the future. And so there's Axis long-term equity investors don't have to worry about the performance. It's doing quite well. It has recovered in the last few months or so. Since the middle of 2019, it has recovered. Mirae fund, Mirae tax saver fund investors have nothing to worry about as well. So there's practically not much to choose, and the Axis fund has bounced back in the last 6 months. Getting rid of the last about 2 years dull performance before. So that's what I want to say in this review. Please write to SEBI following the format in the article. Thank you so much.